So, ladies and gentlemen, dear colleagues of the institutional and banking sectors, dear members of the press, good morning, and I would say also good spring, although it is the first day of the new spring. It starts a little bit in a Brussels way and a very shy way, but nevertheless. For those who don't know me, I am Guido Raafvoet. I'm the Chief Executive of the European Banking Federation, but I remind you to switch off your mobile phones or at least switch them to mute. And finally, I'm pleased to add that we have put everything in place for this conference to have the lowest possible carbon footprint. So please help us to keep it as such. So you may put your use the boxes we have outside at your disposal to recycle the papers you will not be keeping. But for now, and without further ado, I would like to launch the proceedings of the day by inviting the President of the European Banking Federation, Clausen, to take the floor.
Thank you, Guido. It's a great pleasure for me also to welcome you all. A special welcome, of course, to President Herman van Rompuy, who is not here yet, but will be here in a few minutes. Also representatives of the European Commission, from the European Parliament, for the European Central Bank, and of course, a warm welcome and a thank to all our speakers. And maybe most importantly, thank you for coming, all our guests, to participate in this debate. The conference is called Banks for Growth. I think nobody can disagree. It's an interesting subject, but the reality is, of course, that it is probably the main theme for today is to discuss the balancing to 12%. So in reality, the discussion was, will Europe be around 9% capital, core capital, or 10, or something like that? It seemed like a long time ago, and indeed, a lot of things have happened since then. Since then, other discussions, maybe even more important discussions, have actually emerged. A long discussion on bail-in capital, how to resolve the banking system. Systemic add-ons have developed further. Banking union is a reality, more or less by today. We saw the Liikanen report. We have seen structural reforms being passed or being passed as we speak in several countries. We have the discussion on financial transaction tax, and we have a huge number of local initiatives. More or less any country in Europe are right now launching various reforms or changes. They are more or less aligned with the European line, but more or less is probably the right word. Of course, all these changes represent very significant costs to the banking sector. The cost of running a balance sheet, i.e. to finance the economy, has gone up significantly. So of course, as I said, we support the general direction, never again. Of course, we have to create much more financial stability, but at the same time, we need to secure that we don't pile up unnecessary regulation, which is just a cost to the economy. They clearly demonstrate margins, so where you in the old days could have a good sort of negotiation on the margin, I think more or less now it can be looked up in the system. With this capital and this funding and this liquidity, it is indeed the margin. However, the discussion then goes on towards what can the customer do to actually lower the margin, posting more collateral, signing stronger covenants, i.e. reducing risk. So the huge discussion going on is what is it that our customers should do to reduce risk and thereby get the financing at better terms. But of course, this is a real risk. The only thing we're doing, we are also adding in liquidity, longer funding. We're doing a lot of structural changes in the way we calculate risk and so on. So this is not a simple change agenda. It's actually very complicated. Now, how will societies and economies then be impacted? Well, I think, to be honest, the true answer is we don't know. We have seen several calculations. I at least have seen 13 different calculations being made on the macroeconomic impact of the new regulation, and they have a great variety over them. Some shows more or less no impact, and others show quite dramatic impact. I don't think we know. It's something like economic models. It's a little like weather models. You are told by the weatherman that it will be sun all day, and you look out the window and it's snowing. So sometimes you have to look out the window as well. And I think when we look out the window, we clearly see a huge impact on economy. At the same time, we see, of course, benefits from financial stability. So the real answer here is we don't know. But we do know, however, is a lot of things have changed, and there are at least 3 facts supporting this. First of all, we know that the average core Tier 1 ratio before the crisis was 4% in the banking sector, and we know by now it's gone up to 8%. I think it's fair to say that the capital ratios have doubled in European banking. We also know that the 15 largest bankruptcies in the past 5 years, and anything more would be more or less redundant capital. So I think also right now as we speak, when regulating largest bankruptcies we saw, because they lost 6%. So I think recalibration and thinking is important. That is also supported by the fact that nobody have decided 22%. I've asked members of Ecofin, members of Parliament, members of Financial Stability Board, always I ask the same question, who have decided the 22%? And the reality is no one. Every single item have been decided. So there's the CRD4, and there's the recovery resolution add-ons, the systemic add-ons, the GCF add-ons, and the bail-in, and so on and so forth. You keep on growing, but nobody have actually decided the combined number. So maybe it's time to take one step back and look at that number and see if there's something we can do better. Let me comment on 2 of the most recent initiatives briefly, which are also important. One is the banking union, and the banking union is indeed a very encouraging move forward. It's a simple fact. It's the fact that we built the future banking system on 2 pillars, the CRD4, i.e. the rule set of banks that live, and we also built them on the recovery resolution framework, which is, of course, the framework for banks that cannot live. Then we have the one supervisor, which we strongly support. And then what is not finalized yet is, of course, the financing arrangements, resolution funds, and so on. Also a very difficult matter, not because we do not agree we should have some kind of back facility, but the incentives there are also difficult to look through. And then finally, then for a bank to extend such a loan because of the capital ratios, it will be very expensive for good reasons. The risk is, of course, there. So what we will do going forward is we'll probably issue a bond, a corporate bond for this company. And that might be done in another capital market, say the US capital market. So we'll issue bond issuance, $100 million in dollars, fixed rate over 8 years. That's a capital market transaction. Then we will swap the dollars to euros, because the company, of course, needs euros, not dollars. That's a derivative swap. Then we will swap the fixed interest rate into variable interest rate, because the company doesn't want 8-year fixed rate, it wants a variable rate as you go. That's another derivative transaction. Now that's 3 capital market transactions to finance a company which before the crisis would have been a straight bank loan. Now, why should we separate those 3 transactions from banking? Because it is banking. For the company, it's exactly the same. It gets 100 million euros for 8 years in variable rates. It's exactly the same transaction for the company. Now, and that's not only 3 transactions, it's probably much, much more, because each of these transactions then enters the capital market and are traded from one bank to another until it finally hits the bank or the customer in the US that had the opposite position and wants to have that derivative exposure, because it's natural for that company to do that. So all in all, as I said in my opening remark, we strongly support the general idea of all the new regulation. We need more financial stability. We need stronger banks with stronger balance sheets. So it's not a question of whether to do it or not. It's just a question of the calibration. These were my opening remarks, and now it's my great pleasure to welcome President Van Rompuy. Thank you very much for having accepted to come here today and giving the opening speech for our conference. Thank you. Welcome.
Mr. Chairman, ladies and gentlemen, it's a great pleasure to give the opening keynote speech of your Banking for Growth conference. As you can imagine, the European banking system has been at the heart of many of our late-night European Council meetings, either directly or indirectly. And I'm convinced that the health of our banking system is essential to our recovery and to our growth potential. But I'm also conscious of the challenge of dealing with an evolving institutional for growth. Second objective, correcting public finances and external imbalances in a gradual, growth-friendly and differentiated way. Fiscal positions have improved in the last 2 years, even dramatically. External imbalances driven by private sector leverage and large divergences in competitiveness are slowly but surely being brought under control. And this is all contributing to laying the foundations for stronger and healthier growth in the future. We are focusing on structural fiscal deficits, more than on nominal targets, and we are using all the possibilities foreseen by our fiscal rules. Despite all that has been said about the weaknesses of the euro area's economic governance, the reality today is that we are correcting medium and long-term economic challenges more rapidly and more successfully than any other advanced economy. Third objective, supporting economic activity and job creation in the short term. The economic adjustment is long, and I am fully aware of the painful impact it can have on employment in certain parts of our Union, partly contributed to the crisis. The roadmap we have drawn together to overcome these flaws is essential to ensure we can all reap the full potential of our economic and monetary union. I want to focus here today on this roadmap, and particularly on the need to build an integrated financial framework to anchor financial stability in the short term and to repair the EMU's architecture in the medium term. We had originally built monetary union on the premise that financial integration would unequivocally contribute to convergence and to stability. The reality is that when the crisis hit, acute financial fragmentation came to undermine the risk-sharing properties of the financial system. We need to repair this essential feature of our financial system, because as much as financial integration was a source of economic convergence, we have seen how financial de-integration could potentially fracture our monetary union. In order to reintegrate our financial system, there is an emerging consensus on the fact that we need first an enhanced regulatory framework for banks, a single rule book. Second, a single supervisory framework to enforce it at a time when we would need to invest public resources in our future. This also came at a huge political and social costs, and we must now all live up to the promise that a collective failure of such a scale will never happen again. This means regulating, sometimes strongly, areas that were not regulated, starting with capital adequacy ratios, liquidity standards, or even compensation rules. And we are fully aware that we also need to do this wisely and with composure, so as not to undermine the future health of our financial system and the speed of our economic recovery. And that's why we remain attentive to your remarks. But even with the best regulation, there needs to be strong and independent supervisors. We had made some progress in strengthening supervision in Europe following the Larosière report in 2009. But we needed to go further. In December 2012, the Council of Ministers came to an agreement on the establishment of a single supervisory mechanism centered on the euro area but open to all countries. This mechanism, along with the new regulatory framework, will substantially enhance supervision. It will improve the capacity to supervise significant involvement of taxpayers. The first step in fixing this situation is to establish a resolution framework and national resolution funds fed by the financial industry so as to limit costs to taxpayers. The European Commission's Bank Recovery and Resolution Directive, currently under discussion, will achieve this and shall be concluded by June. But we will need to follow up quickly with the creation of a real European resolution authority that can take the kind of executive and emergency decisions required in the context of bank failures. The difficulty, delays, and eventually the costs in coming to an agreement in some countries illustrate the need for a real European authority that can take decisions in the best interest of the Union as a whole. Establishing European supervision but maintaining national responsibility to resolve or restructure failing banks would be politically unsustainable, and experience has proven that it is potentially dangerous. The European Council decided in December on the creation of a common resolution mechanism. To this effect, the European Commission will make in the summer an additional legislative proposal for a resolution mechanism that will eventually need to be backed by an appropriate, and that's a daunting task that will raise very difficult technical and political questions. But it is one that we all recognize as absolutely necessary and to which we are committed. I know that in the times of financial markets, this process can seem very long, but we are politically committed to achieve such a fully integrated financial framework. As I said, it will take time, but we will get there. The reports I prepared for the European Council towards a genuine economic and monetary union helped steer the debate and maintain pressure on the leaders to embark on a so-called banking union. We made significant